Hello and welcome to Premier Study and Investing. It's great to have you. Thanks for stopping by. To Premier Study and Investing, I'm going to be looking at a Vanguard fund called VGT is the ticker, or otherwise known as the Vanguard Information Technology Index Fund. Listen to a lot of economists out there. Blockworks is a great YouTube channel if you haven't heard about it. Also, I'm really surprised that Double Line doesn't get more views than they do. I think Jeffrey Gundlach and Jeffrey Sherman, pretty legit. So anyways, these are some things to check out. If you spend a lot of time looking at economics, I don't know about you guys, but sometimes you get the sense that this information is only as good until the next inflation report, the next jobs report, the next manufacturers index, whatever, right? Next Fed meeting. So I just want to look at this really quick. It's interesting. It also came up in our optimization. It's basically modern portfolio theory, and it was chosen a lot of times for the higher growth strategies by the model. And honestly, I never invested in this before. I didn't know much about it. One of the great things, Vanguard, you can see it has an expense ratio of 0.10, so 0.1%, which is really great. And you can see the run up here. Yeah, it was chosen a lot by this modern portfolio theory model that I created and put on Patreon and had been using and learned in graduate school. And I was like, what is this? Really, I just picked from all 11 sectors 2 highly liquid ETFs for consumer staples or industrials or information technology, healthcare. Well, this is one that I picked. And since it was selected by that model, I wanted to look at it. I will go really quickly here to the performance. I guess we could look at holdings really quick if you want. But it's an all equity tech fund. These are the top 10 holdings: Apple, Microsoft, Nvidia, Broadcom, Adobe, Cisco, Salesforce, Accenture, Oracle, and AMD. So, and it's got quite a lot: 21% Apple, 16.53% in Microsoft. Yes. But I wanted to show you this because this is really interesting. I was sharing with somebody the performance. So year to date, it's had a great year. Up 33.9, so called 34%. But some of the 3-month, 1 year, 3 years, 12.1%, 5-year average 17.22%, 10-year 19.52. So that's a pretty amazing 10-year run of 20% return. So then I came across this, and it really blew me away because I was reading it to somebody, and I said, okay. I didn't tell them the name of the fund. I just said, listen to these returns. Tell me what you think. 8.86% return. The next year, 14.78. The year after that, 2008, dropped 42%. Oof. But the following year, up 61.89%, up 62%. I'll just read them in whole numbers. I'll round to the whole number in case you're listening. You don't get the decimals aren't important. So 2010, up 13%. 2011, up 1%. Then up 14, up 31, up 18, up 5, up 14, up 37%. That's 2017. 2018, up 2%. That was the year that interest rates increased a lot and the markets did not like it. 2019, up 49% in 2019. 2020, up 46%, then up 30%, and then in 2022, lost 30%. So 2 big down years. That's 17 years that we just looked at. There was 2 years of losses, but when it loses big. 2008, it lost 42%. And in 2022, it lost 29%. Now, I think the S&P 500 for the year in 2022 was 20%, 21%, 22%. Not 100% sure on that. You could whip out your phone real quick and look at that. But it was a bad year for equities, right? 2022. And for bonds. So 2022 was a rough year. So, but only 2 losing years. But when it loses big. And when it loses, the year after it loses big, we had a 62% return following the loss in 2008. So the next year came back 62%. And then 2023, what have we done? I don't want to go on and on here. I should have gone to the performance button. And the 1 year performance this year has been up about 28, year to date, 34% in 2023. So a pretty good rebound this year. Now, I don't know, maybe we missed it, but I just thought that was really, really interesting. I wanted to put together this just little Excel sheet, right? Take the numbers, because I was kind of curious. I was like, I round them up to whole numbers: 3%, 9%, 15, negative 43, 62, 13, plus 1, plus 14, plus 61, plus 18, plus 5. I mean, all these numbers, they just sound amazing when you read them off like that. Like if you're plus 5 on something, you're like, yeah, but I mean, plus 5, like that's great. Plus 5%, fine, I'll take it. Because in the next 2 years, plus 14 and plus 37, like you don't even care. Like you're just, and these are not losing years. Plus 2%, still not great, but I mean, you made some money. I don't know what inflation was in 2018, but you made some money. But then the next year, 49%, followed by 46%. Followed by 30%, right? Then you lose 30% of that last year. If you started in 2005, January 1, $100 investment, it'd grow to 103, 112, 129, down to 73, but then 119, 134, 136, 155, 203. So it's taken you 8 years to double your money at that point. Is that right? 9 years. Okay, just that's why I counted. And then by $240, $251, $287, $394, $401, $597, $872, $1,134, and then after that 30% loss in 2022. $739. Return over those, was it 18 return years, 18 returns, you have an average return of 12.2%, which is basically what we've been looking at. Is if you want to double your money every 7 years. Is that right? Yeah, you need the 12.25% return. So that's kind of what I punch in the model when I run it, and so that's why it's pulling up this fund. Now the model that I putting out was only 5 years of returns. So here's the formula if you want to know how to do this. Product = geo mean, open parentheses, select your returns. 1, 2, 3, 4 for the last 5 years. Add one. Close it. Double close and subtract 1. 15% return over the last 5 years. One is this one on the right, we're using log returns, which are additive. We talk about this. There's a whole video on log returns versus arithmetic returns. And these are really nice. You can see you can just add them up and divide by 5. But you can also see they're a little bit different, the way that they sum. And this is a percent, and this is not a percent. So this is actually the greater volatility that you have, and like you have big swings in these, right? 2%, 49, 46, plus 30, and then minus 30. When you have big swings like that, the geometric average and the annual, the log return average tends to deviate. I just didn't know anything about this fund, and I thought, well, that's pretty wild to have 15% return over the last 5 years, 12.2% return over the last 17 years, to see these like massive swings. Yeah, when I first read these returns, it just blew me away. I just had no idea that the IT sector has done that. And so when it gets hurt bad. But all in all, I mean, wow, it's really been a great run for. Obviously, it's mostly Microsoft and Apple, but man, they've had a great run. So um, again, past performance doesn't predict what's going to happen in the future. Um, but some people argue that these companies are so strong because they're essentially monopolies. I mean, it's going to be very hard to dethrone Apple for phones. I mean, it's not. Maybe they're not innovating that much at this time. From one phone to the next phone, you could have a phone that's basically 4 or 5 years old, maybe 2 or 3 years old, and it still basically has all the same functions as if you were to go out and spend, I don't know what it is, $1,600 for the newest one. I don't even know what the newest one is, but pretty interesting stuff. Again, I think Microsoft has got a big bump with AI. I think they're the largest investor in ChatGPT. Or maybe some of the best exposure. I mean, I'm not going to go on and on about what's in these because I don't know all these companies inside and out. Obviously, it's a huge fund, but it does seem to be year over year really a strong performer. I mean, some of these years are just incredible, especially after coming off losses like this. So maybe if we have another big sell-off in 2024, 2025 might be the year to jump on it. I mean, I don't know, but yeah, ETFs with these kind of, wow, right? That's all. So anyways, we can always go back to the economists and look at the jolts and all this other data. But sometimes, it's just is like, well, how do I incorporate that into a strategy? I don't know if you guys ever feel like that, but sometimes I feel like this is really interesting. There's very smart people doing a lot of research on, say, credit card debt, delinquencies, you know, sovereign debt to GDP, a million different, really, really, really interesting things, truly. But sometimes you can listen to an hour and a half long podcast and just feel like, I mean, okay. And it's really hard to find anybody that's bullish at this point. I mean, I think James Bianco is about the only guy that I've really heard that is saying, hey, we're going to have a soft landing. I think Edward Yardeni is kind of the first guy that I heard talking about a rolling recession, or each sector is going to kind of take their turn. But the whole economy, or the whole stock market, you could say, isn't going to feel the pains of a recession all at the same time. A lot of people, I mean, yeah, a lot of people are getting somewhat impatient on, hey, where's this recession? I think especially David Hunter has a really interesting perspective that if the S&P 500 hits all-time new highs, and we're at 4,450 this weekend. This is, what is this? I think September 16th, 2023. Yeah, David Hunter thinks that if S&P 500 gets to all-time highs, and that corresponds with some interest rate cuts, that all the mutual funds and the pension funds and the institutions are not going to be able to sit on the sidelines with dropping short-term rates, and that they're going to want in on the action. Now, that guy always has these like crazy huge calls of, I think he has a call on the S&P 500 for 6,000 to 7,000 points, so that's 50, it's not 50%, so it's like a 40% run up, and then a huge crash. I mean, I think his bottom number is somewhere around 2,000, 2,300. Yeah, I don't know. It's actually really interesting because we were at 36 not that long ago. We were at 36 about a year ago. That's the 5-year chart. Let's do the 1-year chart. Yeah, 35 backs up about a year ago. October 2022, we're at 3,600. And then before the COVID crash, it's really interesting. Where is this? June of 20, 3,000. 2,500 before that. That's an odd image. Anyways, well, I just want to share about VGT, and then probably kind of blabbed on after that. But hey, thanks for joining us. I have been kind of out of the loop studying like madman for CFA level 2. It's really great. I'll try to do a full video on that. But if you've ever thought about really going for it as far as getting into finance as a career, man, you learn so much in CFA. It's really a great program. I've wanted so many times to just like post on LinkedIn like, thank you CFA, this is amazing. It feels like all the dots are starting to connect. And if you remember back in the days when you turned on like a CNBC or any type of like Money Watch or any type of financial channel, there's just so much jargon you couldn't even really understand what they were talking about. It's like it's all just really really nice. All the pieces, all the components of such like a huge thing that impacts our lives, to start to really get a better sense of at least what people are talking about, the theories behind what people are saying. It's been great. So anyway, like I said, I'll try to do a full video on that. Anyway, well, thanks. Bye.